Coming up in today's show, stocks finish higher as inflation comes in as expected, what the Fed might do next, ongoing demand problems in the treasury market, oil futures drop sharply, along with the sell-off in Bitcoin. Hey, what's up guys? Welcome back to the Click Capital Daily Market Show. My name's Jared, I hope you're all doing well. And another day, another new high for the S&P 500 and NASDAQ. Continuing their run higher in this parabolic grind up to finish out the year. And unlike yesterday, today was led by mega cap tech. We saw that funny pattern yesterday of all mega cap 7 stocks falling while we had the equal weight NASDAQ up over 2% in a very strange pattern, and to do with the rebalancing the NASDAQ is doing with their indices to try and reduce the concentration of the Magnificent 7. But nonetheless, investors have forgotten about that and picked them back up today. And it was pretty bullish across the board, all except for energy, oil and gas, with crude oil futures falling and a little bit of weakness in the defensive sector of utilities. And so the big news today is we got inflation numbers for the month of November, with a month-over-month increase of 0.1%, a little bit higher than expected, but all other numbers coming in as expected, with core inflation still at 4%, well above the Fed's target of 2%. That strips out the more volatile food and energy. However, looking at the headline number, year over year, 3.1% increase, and the stock market seemed to like that. However, we still have this interesting dynamic in Fed fund futures, pretty much saying the Fed is done, given over a 41% chance that they think the Fed will cut come March, and this is only a couple of months away, and the price in a full 125 basis points of cuts next year. Have like this article on Barron's says core inflation is holding steady at 4%. It's hard to see the Fed wanting to cut rates anytime soon unless we get a real surprise or something big breaks in the economy or markets, because the Fed themselves are actually kind of leaving the door open for another rate hike. Even though they probably won't, they're still saying they're going to stay higher for longer. And as we all know, there's persistent strength in price growth in areas such as rent, medical care, car insurance, food, a whole bunch of things we all know are going up a lot year over year. It doesn't feel like we're anywhere close to a 2% inflation environment. And just looking at a 10-year chart of the core inflation rate, you can see the true Goldilocks period for markets was after 2009, with interest rates at rock bottom lows, inflation consistently around or under 2%. On top of the Fed's huge quantitative easing, liquidity pumping program, it's no wonder stock markets shot up as much as they did. However, the stock market seems to think this is going to come back down to 2% and less next year. And since we got the Fed funds rate above 5%, that gives the Fed a bit of wiggle room and flexibility to help the economy should it need it. Now, we've got long-term interest rate observer writer Jim Grant saying inflation is not transitory, it's permanent. And he's considered one of the best Fed watchers, and he called the 2007 housing bubble and has been publishing on financial markets for over 40 years. He described inflation as a phenomenon that's not temporary, as many seem to think. He went on to say, whatever this number we're about to see reveals, inflation is importantly not transitory. It's permanent, that you'll never regain the purchasing power you have lost to inflation. There's no such thing as deflation in modern monetary life. We've also got even the Fed's own research saying rate hikes take so long to affect the economy, and that effect may last a decade or more. With their research showing an unexpected 1% increase in interest rates can reduce gross domestic product by 5% for 12 years. That's because the increase in borrowing costs that stems from Fed decisions does not affect all consumers immediately. It typically affects people who need to take new loans, first home buyers, and so it might not all hit at once, but the longer rates stay elevated, the more you're going to feel those effects. And so there can often be a big lag on Fed hikes throughout the economy. And remember, we're coming off years of rock bottom rates, huge Fed liquidity, huge government stimulus program, and that's kind of all drying up. And that process may take years and years to wash out of the system, not just a quick year or so. We also had another treasury auction with soft demand on Monday. It's a sale of 3-year treasury notes. The primary dealers taken up a larger than normal portion of the sale to make up for a lack of enough indirect bidders. And even though CPI came in largely as expected, we did see a little bit of an uptick across the bond yield curve over the last couple of days as well. We can see that in the 2-year bond yield a little over a week ago, got down to 4.54, and that continued volatility remains in the bond market. Here we are at 4.73, and a little bit more of a shallow bounce in the 10-year up to 4.21, which is coinciding with a little bit of a pullback in bond market ETFs, TLT there. Still looking pretty strong though, but we've still got inflation expectations coming down in the market, and that's most likely what's really helping stocks here. Another good thing for inflation in the West is China's already experiencing deflation, with their consumer price index falling 0.5% in November. That's the worst drop since the pandemic, and they've really been trying to jumpstart their economy this year. However, deflation in China, which is still the world's factory of products, we in the West can import some of that deflation in terms of lower cost of products and services. And so the weaker China remains, the more that's going to help bring inflation down in the West. However, that's not unless China government can really get underneath their economy and get it growing again. They're vowing to continue more support with their fiscal and monetary policies to revive the economy and try and get past all their mess in their property sector and kind of readjust to the new world of reglobalization, where a lot of major economies are trying to become a bit more self-sufficient and reduce key risks. And so China's trying to boost their own domestic demand and consumption. And just looking at the China 50 index, they do have a long way to go. The price is currently sitting at 4-year lows, well off their highs from early 21. And just looking on the daily chart here, we are getting a bunch of bottoming signals. And I think going into next year, 2024, this could be one of the biggest contrarian plays, as a lot of people have given up on China, seen net record outflows of capital. However, in my opinion, it's largely been priced in. Chinese government's recognizing that. We saw that with Xi coming onto US soil a few weeks back, trying to come back to the table. And I wouldn't be surprised to see the China stock market being the #1 performing stock market next year. Something no one is expecting or talking about. And a good way to play that could be with one of their most biggest and profitable internet companies, Alibaba, currently trading just over $71 a share. And believe it or not, that's below their IPO price in 2014 of $92 a share. And in that time, they've taken annual revenue from $8.4 billion to $125 billion. And again, this just illustrates how hard investing and trading can be sometimes, because your analysis could be perfectly correct with the growth of the underlying business. However, what the stock market does with its valuation can be a completely different thing. However, in the long term, stock prices most of the time come back to correlate with revenue and profits. We also have quite the bullish consensus developing in the stock market. There's some saying we may get a mild recession. Stocks should only go 14% lower, but that'll set up a really great buying opportunity before a rally in the second half. So whatever dip we get in the stock market is going to be bought by a lot of people. And they could be right, because the Fed does have room to move on interest rates. The Fed put will always be there. If something bad happens, they'll come in, flood the market with liquidity, help the banks out, and once more that just continues to exacerbate the gap between the rich and the poor. Although most people just don't understand that. A lot of people think Mega Cap 7 is going to continue ripping next year, led by NVDA, the best performing stock of the bunch this year. And so wouldn't it be a contrarian outcome if NVIDIA was one of the worst performing stocks next year and the Mega Cap 7 actually underperformed significantly? Moving on to commodities, we saw oil drop sharply again today on concerns over the outlook for oil demand. Got that weak CPI coming out of China, rise in oil production from non-OPEC countries, and the strong data last week from the US jobs market showing unemployment is still near record lows. A lot of people have jobs, and some still continuing build up in supplies of gas as well. And we've recently seen OPEC Plus kind of lose any influence over the oil market. Didn't seem to be on the same page recently, delaying their meeting. However, some saying they can regain their influence over the market. With their latest meeting at the end of last month, they announced cuts of 2.2 million barrels a day, with the Saudis calling on other members to help stabilize prices. But at the same time, we've got a boom in US output, with some speculating the Saudis may go the other way and try and flush the market and crash prices to try and burn out smaller suppliers, and then they can come back with more control. And speaking long term on oil, JP Morgan's top energy strategist says we won't see peak oil demand in our lifetime. That's because there's a huge hidden demand from emerging markets, and that demand will outpace supply, creating tightness in the market in the coming years. And just looking at the price action in crude oil futures, we are finishing the year out pretty weak here, coming back down to those lows we saw in mid-year around June, around $67.50 a barrel. That'll be a key support level to see whether the market can hold there. Also got a big drop in natty gas as well, getting really technically oversold here, and that's weighing down the whole commodity market, which it too is also coming down to major support zone. We've also got gold pulling back, and this big reversal shooting star candle may be getting confirmed here. We've got to close below the 50-day VWAP, and we do have a lot of bullish gold consensus out there, so maybe gold does pull back and once again is proving to be a really tough long trade and won't go into a nice parabolic uptrend to make it easy for us. So we could continue trading down into the low 1900s here over the coming days and weeks. And one of the best performing commodities continues to be uranium, trading close to multi-year highs here. We also got a bit of a sharp pullback in the price of Bitcoin over the past 24 hours. That had been trading up really well to highs as well. Seems to be correlating with its traditional counterpart of gold in price action a bit as well. And just looking at the chart of Bitcoin, we quite often see these big surprise flushes out of nowhere, as the market has probably picked up a lot of longs. Then yesterday pulled back almost 6% on big volume, and we'll see whether that prior resistance can turn into support just above 40,000 a coin. Moving on, it's no surprise we got the fear and greed index still quite elevated here at 68, and corporate insiders pulling back their selling a little bit, but still quite elevated there. And just looking at my indicators, institutional buying percentage still in the neutral zone, actually climbing a little bit to 51%. Still not sure whether it's a top or not. And we've got the S&P 500 oscillator climbing once again. Was looking like it was setting up a bit of a divergence a few days ago, but since we've broken out to new highs, it seems to be walking the line, as there is a lot of parabolic momentum in this market, and we can see that here in my regular charts as well. Market hasn't done so much as a 1% pullback since before we bottomed back in late October. And I've just reorganized my daily watch list with how we go through all the major categories. So after the main US indices, we're going to go straight into breadth, and I'm going to start off by looking at a screen for all stocks and ETFs breaking out to 52-week highs. They trade a minimum of $1 million of shares or units in the current session, and we can see the S&P 500 and the Nasdaq hitting new 52-week highs, along with some semis, AMD and Broadcom, some other tech stocks like Adobe, Uber, which was added to the S&P 500, JP Morgan, Visa, Costco, and coming in at 508 stocks and ETFs breaking out to 52-week highs today. On the other hand, looking at stocks hitting 52-week lows, coming in at 91. At the top of the pack, the most liquid being ExxonMobil, that falling crude price. Also Occidental. Still got stocks and ETFs related to China hitting 52-week lows, and a bunch of other energy, oil and gas stocks as well. And there's breadth as measured by stocks above the 200-day average, holding pretty strong here at 65%. And the traditional new highs versus new lows also acting pretty bullish, along with volatility dropping once again. VIX super low here, just above 12. And option dealers pretty chill about what they see on the horizon. Less than 2 points of volatility risk premium in the market, with a super low put call ratio at 0.69, showing a lot of people still piling into calls. Another asset sensitive to risk, high yield bonds in a parabolic short-term uptrend, and the dollar just kind of sitting there under 104. International stock indices pretty flat to start the week off, not much happening there. Then we've still got high beta and growth still trading pretty strong, and there's commodities just getting whacked versus stocks. Over to stock sectors today, the loser by far was the cannabis ETF, falling a huge 13.6%. I couldn't see any major news. The DEA did look to reschedule synthetic cannabis down to a Schedule 1, and what looks like a preemptive move to reschedule natural cannabis from 1 to 3. However, something spooked the market here today that I'm going to look a bit more into later on and see what I can report to you tomorrow on that. The winning sector today was biotech, up 1.55%. Coming in second was cybersecurity stocks, and third was semiconductor ETF, breaking out to new all-time highs. Second losing sector was clean energy, still struggling to find a bottom here, and the gold junior miners coming in third. Still got the BlackRock barometer trading really strong and parabolic. Apple's still only a few points away from all-time highs. Same deal with Microsoft. And we had a huge pop in Macy's yesterday, up almost 20% on rumors private equity is going to try and take them out, take them private. We've got a downgrade today from Citi saying they're skeptical of that deal going through, so we fell 8%. And this is a stock that's come off really cheap valuations. Looking at my stock fair value indicator, it's still got it at $41 a share. Only a month ago, we were trading down $11 a share. And some research shows that real estate alone is worth over $3 billion. And the market cap today, even after this big pop the last month, it's still only $5.2 billion. There's Carl Icahn's stock still trading down and hitting new 52-week lows, just under $16 a share. And what a tough year he's had, with the stock getting up to $54 a share, then was hit back in May by Hindenburg Research short seller report questioning a lot of things. He's tried to do more financial engineering to recover, but the market seems to have given up on that. And what a way to finish out a 60-year career on Wall Street at decade lows. Other than that, we've still got the banks trading pretty nicely here in short-term uptrend. Okay, so there we are in the S&P 500. Continuing to march higher. Market seems to be convinced now that soft landing is inevitable. So any surprise to this market is going to be very upsetting from this low VIX environment. However, this is a very tough environment to short in when we're grinding higher and low volatility like this. And we do have some improvements in breadth as well to back it up. And there's only about 2 weeks left in the year. So it looks like we're going to finish on a strong note here. And let's say from here on out, volume and volatility, along with the news cycle, is going to start dying down, and we shouldn't get too many big moves until we get well into January. That's all I got for you today. Thanks very much for tuning in to my daily show, and I'll be back as usual tomorrow night. Cheers.